All right, we are live, and just want to thank everybody for joining us. Just give us a few more minutes. We're gonna let people join. We are in for a very exciting topic, and I'm sure most of you here are here because of the topic. All right, so just a few more minutes, and we will go live. Where's everybody from, by the way? Locations. Okay, just a few more minutes and we'll go. Where's all right, just give us a few more minutes. All right, a few more minutes. Oh, we have New Jersey. We have someone from India. Wow. Nice. There we go. Tay, you're back. All right. We had a little technical difficulty before. Oh.
Yeah, my apologies.
No, no problem. Thank you, Tay. You're in Korea, so you're 14 hours ahead now?
Yeah, absolutely right. Yeah, that's correct. Yep.
So it's you're just waking up and it's the evening here on the East Coast. So we have Denver. Nice. Cairo, Egypt. All right. We have 25 people on here.
Wow, we are going global. Yeah.
Yeah, this is it. I'm here in New Jersey, central New Jersey. Tay, you're in Korea. We have India here. We have Greenport, New York. We have Gracie's in New Jersey. All right. A few more moments, and we are going to get started. Okay. All right. Tay, you ready? Who's ready?
Yeah, I'm good to go.
Who's ready to get started? Type yes, Y for yes, or... All right. Let's give it one more minute. I see more people joining. I want to give them an opportunity. I don't want them to miss this. All right. 27 people on. Wait, is that Mark, Nicole? All right, we're going live. All right. Okay, so why single family rental, SFR? Single family homes for rent. Why is it the next big thing? Look, we see a lot of people talking about multifamily, and I see presentations how they're talking about how you should scale up from single family to multifamily. Well, we see the opposite. We see how do you go from multifamily and scale into single family? And we're going to get to it in this presentation. Okay, so today's agenda, we're going to talk about who we are and what we do, the history of institutional play in the SFR sector, the evolution of the SFR landscape at scale, what's ahead on the SFR path, and then we'll leave it open at the end with a Q&A. Okay? All right, so my background. My background really was influenced from my father. My father's a retired dentist, did very well for himself, investing actively. I later on achieved my master's degree in real estate property management from Drexel. And in 2012, I opened up Levine Capital Management as a way to help my father go from an active investor into a passive investor, where I would help manage his private lending, where he would lend to flippers, real estate flippers, developers, hard money lending, and also I would help manage his real estate syndications and investing in funds. Later on in 2018, I discovered that there's a secondary market for real estate loans where there's liquidity. So I teamed up with Arcade Group. We create Arcade Capital as a way to diversify our debt portfolio to create liquidity for our books. And we were able to either fund the loan and sell the loan to a secondary market or participate in loans with other investors. And then in 2019 was the year where we launched a co-investment platform with TCS Attica Homes. And I also created the aggregation fund. So what is TCS Attica Homes? They are they're a private equity firm where they are looking to be the Blackstone of workforce housing. They have a larger minimum investment. Typically, it's going to be $5 million now. You can invest with Levine Capital with a lower denomination. And aggregation fund is the entity that we invest through because we aggregate our capital and other investor capital when we bring down the minimum investment. So we bring down the minimum investment for you to invest with us where we meet that target investment. Does that make sense to everybody? Okay, good. Okay, next slide.
Okay, so hi everyone. My name is Tay, and I work with Adam as a partner. Just to give you my brief background and how I got involved in this real estate journey. I went to Michigan State for undergrad and the University of Michigan for graduate school, where I study accounting and finance. To this day, I proudly consider myself a Wolverine with Spartan spirit. I'm wondering if anybody from this school. So go blue, go green. Upon graduation, I started my career at EY, mostly auditing private equity firms and hedge funds. Afterward, I worked at Goldman Sachs, analyzing the firm's corporate debt portfolio of nearly $300 billion. Then I became really, really fascinated with real estate as a means to build long-term wealth, and met Adam a couple of years ago at one of the real estate meetup events. A year later, I learned of his partnership with TCS Attica Homes and their solid business plan with focus on the affordable SFR space, which was really aligned with my investment philosophy. So after doing due diligence, I decided to invest in their fund as an LP, limited partner. However, I was super eager to actively learn what was going on behind the scene and gain hands-on experience. Naturally, my in-depth involvement evolved into partnership with Adam. So at Levine Capital, among other things, I mostly help with financial analysis and due diligence of deals and sponsors by leveraging my career background. Okay, so now that we talked about ourselves, let's switch gears and jump right into our main topic today.
Okay, so we're going from the transition from SFR 1.0 to SFR 2.0. Tay, take it away.
Yeah, so single-family rental SFR investing has been around for a very long time, but not much fundamentally changed until recently. So most investors who own the single-family units were wealthy local people. This kind of represents SFR 1.0. Where the majority of transactions took place directly between end consumers. Then, post-financial crisis, for the first time in history, the big, large institutional investors emerged and snapped up large number of properties, which can be dubbed as SFR 2.0, so to speak, right? So now Adam is going to take us through the relevant historical backdrop and how the stage was set for SFRs to become institutionalized. Hey, Adam, take it away.
Okay. So it's a really interesting story how history repeats itself. Let's go back to the 1980s, the deregulation that allowed small banks to make risky investments in real estate. Has anybody ever heard of the S&L crisis? Type yes if you heard of it. No, maybe not. Well, so usually what happens is, the banks, they loosen up credit, they start lending, they overbuilt like crazy. So there's a boom, there's a bubble, there's a bust. Okay. And the same thing happened again 20 years later, right? With the SFR market. But going back to the 90s, right? That's when there was, in essence, a bailout. And this is when institutional investors started investing in real estate. Whereas 2 decades ago, 2 decades later from the 90s, let's say multifamily became a $3.4 trillion asset class. Whereas this is 55% owned by institutional investors. Residential rental housing is it's $2 trillion owned by at an institutional level. And really, like I mentioned before, there's similarities between the SNL crisis and 20 years later. Opportunity funds were created basically to the government. They offer bailouts, and then they offer incentives for investors to basically buy properties cheap and to really help stabilize the market. So really, investors, they save the day because they help stabilize a market. And 20 years later is when we're going to get into the SFR 2.0. Does that make sense to everybody over here? Yes, the RTC debacle. Yes, Raj, absolutely. I'm trying to keep it at a high level for everybody because I know that people they may not be familiar, but yes, that was the receivership for the government to help dispose of the bank's assets, and that's when the opportunity funds were created. All right, that makes sense for everybody. Okay, let's go to the next slide. All right, so this is really interesting. I'm sure has anybody here seen the movie The Big Short? Okay. Well, this is the history of the SFR 2.0, the housing crisis. So now we're going from the 90s, 20 years later, we're going to 2008. The world's coming to an end. This is a black swan event. The liar's loans, you've probably seen the movie. Maybe you haven't. Go see it. It's a great movie. But really what happened is that at the height of the foreclosure crisis, the government came in again. They offer incentives because they want to stabilize the housing market. They offer incentives for institutional investors to buy up distressed debt from Fannie Mae. And this is when large institutional investors came into it. You had investors like Sam Zell thought this is crazy. He's like, I don't know how anybody's come under thousands of houses. Then you have Warren Buffett said, I would buy a couple 100,000 homes if I could figure out a way how to manage them. Well, guess what? In 2011 and 12, large institutional players, they professionalized the SFR sector. And they accomplished the goal. Does that make sense to everybody? Raj, Nicole, Gracie? Hey, you want to chime in on this a little bit?
No, I mean, this is really amazing. I mean, if you think about it, because even a venerable investor used to think that it's not even thinkable to scale up the single family houses by the nature of the dispersed location across the nation. But then we're going to talk about how things are really evolved in support of the takeoff of SFR sector, which is really the mind blowing.
It's mind-blowing. I mean, we're talking about large private equity groups, hedge funds that never even thought about this asset class, and they bought up tens of thousands of homes, and they made this into an institutional asset. And we'll explain more on how it's done. Okay. So where's SFR standing? Okay. So single-family homes, right? This is the largest asset class. If you look from the left to the right, you're going to see over here that U.S. housing is the largest out of every asset class. You're talking about stocks. You're talking about treasuries, single-family mortgages, corporate debt. The 25 was it 25
trillion
trillion with a T makes up the single family housing market. That's a huge market up for grab. Okay. 35 trillion is the entire housing market compared to everything from multifamily mortgages, asset-backed securities, commercial mortgages from right to left. Does that make sense to everybody? Exact. Right. That made it easier to manage Raj, you're absolutely correct. Dealing with economies of scale. Yes, technology. We're going to get through that. Raj, you're 100% correct on this. Thank you for pointing that out. Tay, you want to chime in a little bit more on this?
I think this is a pretty self-explanatory. So we wanted to point out how big is a single-family market as a whole compared to other asset classes. So yeah, we can get to a little bit more detail of a macro view of a U.S. single-family home. So let's see how SFR stacks up against other real estate classes. So the value of a single-family rentals is estimated to be more than $3 trillion, slightly lower than multifamily, but it's really larger than other sectors such as office and retail and so forth. And if we break down the different types of multifamily building on the right side, the single-family rentals are bigger in number than the various subtypes of multifamily. And single-family rentals make up about 17% of 93 million single-family homes and 35% of all rentals. So it's a huge proportion in relation to other commercial real estate asset classes.
Okay, so now we're entering SFR 3.0. And this is where the fun begins. Why now? So it's interesting to note that the share of institutional owners in the SFR market is still very small. Single family rental is the fastest growing segment of the housing market. We expect the share of institutions to rise in the coming years. Okay. These are some recent articles. I literally Google every day, and I'm finding new developments, and this is super exciting. For example, you have Rockpoint Group. Rockpoint Group missed out the last decade on this SFR buying spree like what Blackstone did. They didn't think it was possible to manage thousands of houses. They discovered it's a proven concept, and guess what? They formed a joint venture with Levine Capital, a $250 million joint venture. So they're in it. The goal is to buy, renovate between 4,500 to 5,000 homes. It's pretty excited. Okay, here's some more articles that you see. So just Google and you'll see, or you could always reach out to us. I'll be more than happy to share with you the articles that we find, and there's a lot of information out there. Okay, so now we're dealing with there's a few. So institutional interest has intensified with scalability. We're talking about ways to, manage with economies of scale, improve capital markets, attractive risk reward, and technological advances. Okay, so what's really interesting is, like what Raj mentioned over here, is economies of scale. When you could do things in bulk, meaning if you could buy materials in bulk, you could do things cheaper. A small mom and pop investor is not going to get the same type of discounts as someone that's buying things in bulk. The same thing with contractors. When you could constantly have your contractors or workers on your payroll and you constantly give them work, you could negotiate better pricing. You already have your vendors. They're there. They're ongoing with you. And property management, obviously, when you're managing more, you could do things cheaper. So really, in a nutshell, at a high level view, the larger you scale this thing up, the more you're going to shrink your cost. So you're going to really have more operational efficiencies. Tay, I know you have some light that you want to share.
Yeah, I just want to briefly touch on the margin front. So yeah, as Adam mentioned, it's really important to achieve economic scale because it's going to be directly related to the cost reduction. So because of scattered nature, so SFR in general is more expensive to operate and manage than multifamily rentals. So SFR offers significant opportunities for better operating margin as long as institutional operators scale up with a larger portfolio. So at the end of the day, the achievement of economy of scale is paramount to the success of SFR investments.
Exactly. And what's happening now is what they're discovering is when you're managing, like, let's say thousands of units, you're going to have the same operational efficiencies or even better than compared to like multifamily. And I saw that Raj, yeah, he had that here. Exactly. Hit the nail right on the head. Okay. Does that make sense to everybody? You want us to clear anything up on that? Type yes to move on. Okay. I think everybody's got it. All right. So this is interesting. So improved capital markets. So I'm a lender myself. Like I mentioned in the beginning, I have my other partnership, Arca Capital, where we lend to investors who either buy, fix, and sell houses, or buy, build, and sell, or buy, build, rehab. And what's really interesting is that there was never this type of financing before for the SFR market. I mean, we're talking about, Arbor is a mortgage REIT. CoreVest is an originator that's owned by Redwood Realty Trust. Tora Capital is a secondary market. In fact, my company, Arca Capital, we sell loans to Tora Capital. We have a correspondent relationship with them. And really what's happening at a high level view, increased liquidity in the secondary markets is going to offer more favorable financing. And this offers reduced cost of capital, and there's also increased flexibility. And this is in terms of, we're talking about lines of credit for if you're going to buy, fix, and sell, or buy, build, and sell, and portfolio debt. You could actually, how do you scale up single family? And let's say there's a 100-unit portfolio. You could take on one loan to buy a 100-unit portfolio. So yeah, it's easy to scale with the financing that's available. Another important factor that I was reading in an institutional magazine is this is more for the institutional investors. Investment banks have embraced this sector where they're offering lines of credit, warehouse credit facilities to asset managers to buy, rehab, and then eventually there's a whole securitizations market for when the portfolio is stabilized, they could refinance. And really, this is an evolution that was never available a decade ago, and it's all coming now. And if anything, it's improving more as we go. I mean, my company, Arca Capital, we just lowered our rates recently for the rental loans, so it's only getting better. And so if you're an active investor, you could take advantage of it. If you're an institutional investor, you could take advantage. But obviously, if you're a larger investor, you're going to obviously have better terms than a retail investor. That's just the nature of the business we're in. Tay, you want to shine any more light on this?
I mean, you're really like a sum it up perfectly. So
does that make sense to everybody? I'm trying to keep it very simple. If anybody have questions, let me know. Does that make simple? Does that make sense?
Yeah, because the leverage is essentially the hallmark of a real estate investing. So it's really like helpful to help the SFR market take off even further with this improved capital market. Yeah.
So to make it very simple, let's say it's a multifamily building. You're going to go take on a loan to buy 100 units, right? Well, guess what? Let's say you have a 100-unit portfolio of single-family houses. You could take on a portfolio loan to buy those 100 units. Or let's say you want to buy 100 units. You could take on a line of credit to buy, renovate, and then eventually refinance into portfolio debt. So there is plenty of capital available, and it's flexible, and it's there. And there's liquidity that's bringing down the pricing. Leverage is increasing. So it's overall it's benefiting all of us. All right. I think everybody's good on this.
Yeah. Okay. So I'll touch on the risk reward side briefly. So single family home prices fell behind multifamily is significantly. However, single family price volatility is more stable, lower than multifamily. So if you look at the table on the right, historical volatility shows single family price volatility averaged about 6.4% per year for the last 10 years. Over the same period, volatility in multifamily prices was much higher at 14% per year. So a portfolio of single family homes has much lower price volatility than other commercial real estate properties, ultimately yielding the best risk-adjusted return. So this is certainly one of the most attractive characteristic of SFR to investor. So institutional investor obviously realize a huge potential, upside potential within SFR market. So they really want to come in and take advantage of this great characteristic of SFR.
Thank you, Ted. That was a very good explanation. So technological advances, really, it's improved dramatically. One thing I want to mention is Rockpoint Group. The reason why they didn't enter this a decade ago is because they didn't know how they're going to scale this thing. Technology improved, the capital markets improved, the demographic shifts. That's why they're in it. There's iBuyers as well. I don't know if anybody's heard of the iBuyers, but an iBuyer, in essence, this is a company that uses technology to make an offer on your home instantly. iBuyers represent a dramatic shift in the way people are buying and selling homes, and offering, in many cases, a simpler, more convenient alternative to a traditional home sale. And yeah, Tay, you could
So basically, advanced technology has played a pivotal role in the SFR expansion, and really the key factor for growth of institutional market really lies in on ability to access quality data, right? So, and technology innovation provided tools not only for better analyzing market data, but also for executing every part of the rental process and obtaining easy access to the appropriate data and technology really allows institutional managers to manage the full cycle of a rental property with efficiency. So, for example, web-based platform have made it a lot easier to lease and manage large collections of property, the SFR property. And also when combined with machine learning and AI in the future, even more information can be shared with more people, and the rate of data harvesting will really boost up. And then the data itself will be even more accurate. So with the right technology and automation put in place, the marginal cost of every aspect of business can be substantially low, boosting operating margins.
And really what's happening is, I want to touch a little light on the iBuyers or this AI learning. I mean, they have software out there where literally you could just have all your research at your fingertips and you could make a decision to buy or sell. This is unbelievable, and it's only improving. So, okay. That makes sense to everybody on that, on the technology front point?
I mean, I would say this is really by far the most important factor to really help SFR go further at the institutional level. Yeah, the technology.
That was really one of the one of the pain points that they were trying to figure out was technology, and they figured it out. Like, how do you manage? Well, guess what? They figured it out how to do it, and that's why you're seeing SFR 3.0.
Yeah. Okay, so in this slide, so we have just gone over the 4 foundational elements that make scaling of SFRs actually possible. Now we're going to discuss further a few more underlying factors in favor of SFRs. Essentially, there are financial components, demographic trends, and increased demand for space, both indoor and outdoor. As you can see in this chart, although they're having ups and downs of a graph from left to right, the median house sale price is really trending up alongside the time frame of 2008 to 2020. House prices get higher and higher nationwide lately because available inventories are historically low, and so are mortgage interest rates. So according to the National Association of Realtors, there were 18% fewer homes available for purchase in June 2020 relative to the year before. This seemingly ever increasing home value really puts home buying out of reach and pushing more would be home buyer into renting instead. So there's more renting compared to home ownership.
So in that sense, it's a renter's market, and we really see the future that we're seeing long-term fundamentals that there's going to be more demand for rentals, and there's already a shortage of it, especially a shortage for affordable housing. That's the sector that we're really focused on, but that's off a topic here. But we're a rented nation. That's what we're coming to.
Yeah, exactly. Okay, so among major debt in households, student loan debt looks most concerning and financially burdensome, as shown in this linear upward trend compared to other major debts. So student loan debt nationally shot up from roughly $250 billion in 2003 to close to almost $1.3 trillion in 2016. Almost a five-fold increase. That's such an alarming increase. This mounting level of debt is pressuring down on especially younger borrowers. And these college age groups are most likely approaching the prime home buying age, but unfortunately, many of them are not able to consider buying. So in fact, 30-year-olds with student debt seems to have retreated the most from mortgage borrowing, especially after the crisis through 2012.
So one thing I see people I am acknowledging the in the chat box, and we'll go through at the end. Bill, just to step back on the interest rates. Yes, interest rates are bringing down the cost of financing, but it's also driving up the price of a house, which is really bringing it's taken away from the affordability. And there's other factors too. I mean, there's not enough supply. So yes, you're right. It is a seller's market, and there's let's say this is part. I just touching on this for an exit strategy. Yes, this is probably the right time to sell, and you do see like Invitation Homes, they're selling to their tenants because guess what? It's probably the best time to sell right now in this market because of the low interest rates and the appreciation of these houses, and then they could create liquidity and they could go into other markets. But yeah, thank you for pointing that out.
Okay, so another contributor to financial burden on potential buyers is tight mortgage credit availability, right? So mortgage credit has remained relatively tight since 2008. Among all mortgage originations, you can see in this table, the median FICO score, the top line, has remained above 750, and the 25th percentile FICO, the line in the middle, has remained north of 700. So roughly speaking, these are 35 to 50 points higher than back in the 90s and the early 2000s, the more reasonable underwriting periods. A number of people don't have the qualifying credit score in place. And some consumers aren't even potential participants in the for sale market anymore. Therefore, the limited access to mortgage credit has kind of made renting an affordable solution for some consumers. So this is another factor to pushing people to renting.
Yeah, more so. Yeah, in that sense, the credit, it's not like the old days back, that led up to the crash a decade ago, 2008. The Dodd-Frank, came in, they tightened up lending. So you're going to have, there's no more no-doc loan. to live in a house. And so that definitely took away from buyers. And just wanted to clear anybody. So how's everybody doing now? Everybody good with what we're talking about? Next slide. Okay, let's do it. So,
All right. So
this is an interesting topic with the demographic shifts that's happening.
yeah, so yeah, first of all, like it's worth noting millennials who were born between 1980 and 1996 became the largest age group on record. 87 million people, give or take. And obviously, they are expected to move the needle of housing demand down the path. That being said, one of the notable trends putting more weight into rentals is the fact that these young people tend to get married at older age these days. And of course, marrying a little later in life will not necessarily prevent home buying altogether. Nonetheless, this trend could likely delay home buying and will continue to keep households in renting for extended periods. Simultaneously, we are seeing the growing popularity of leasing just about anything, like from cars to appliances and to even clothing for that matter. So indeed, we live in a renter nation. So at the end of the day, millennials may therefore be more comfortable with the idea of renting and the flexibility it comes with.
Exactly. And another thing too, like most apartments, let's say, are like 2 bedrooms. Well, guess what? You're gonna want to have 3 bedrooms or more. So what are you gonna do? You're gonna move into a single family house. Another thing is, one of my good friends, this wasn't rehearsed, but he's selling his house because he doesn't want to be he doesn't want to be an owner no more because of all the maintenance that he has to deal with. When you're a tenant, you don't have to deal with all the upkeep of the house. So he decided he'd rather invest his money and rent where he lives. So that's what's happening with the millennials.
Okay, so this clearly shows a growing demand for SFR, this slide. I just wanted to point out SFR is both largest and fastest growing segment of the rental market. SFR has grown by more or less 5 million rental units over the last decade. By comparison, institutional and multifamily increased by 1.7 million. Okay, so these slide, more new household formed by renter. So these demographic preference shifts and financial pressures are unlikely to go away anytime soon. So overall, the number of households has grown steadily if you look at the left chart. However, since the financial crisis, the number of owner-occupied households has remained relatively flat, while rental households have increased by almost 8 million. So especially the share of the single-family rental grew really quickly between 2006 and 2016. More than 3.8 million additional households became renters of single-family homes. So according to the Urban Institute, renters will really dominate new households in the future to come. So regarding the chart on the right side, in the 2010 to 2020 decade, about 62% of new households will be renters and 56% for the 2020-2030 decade. So this forecast can translate into another 6 to 9 million new rental households in the next 10 to 15 years. So there are going to be a lot more renters forming the household in the future.
I'm sure everybody's seeing where the sentiment is going. So renter nation, that's really what's happening. Sharif, we'll work. We could get that data. That's sure. We could always get data for you. So so stay to the end. We'll answer more questions on that. But these are all good questions. Thank you. Continue. Really appreciate you asking questions and engaging with us. Thank you.
Okay, so as discussed before, now millennial is the largest age group cohort, surpassing even the boomer generation. As millennial and renter age and grow their family, the increased demand for space is inevitable. In other words, they will naturally gravitate toward a more suburban lifestyle. So if you look at the right chart, the vast majority of multifamily properties have 2 bedrooms or less. So it's safe to say multifamily is not well positioned to provide sufficient space for those who need it. And in order to move into larger places, alternatively, they would have to look for traditional single-family homes. But then, since many of them may not be able to buy housing due to either debt or other some financial constraints, their demand will have to switch over to single-family rentals again. Another point, also as family grow, changing preferences for better schools and family-oriented community could also drive rental demand into SFR rather than multifamily. Okay, this is a pretty interesting empirical measure of SFR demand by utilizing Google Trends. The popularity of the search term homes for rent jumped a lot between second quarter and third quarter this year. So this trend seems to reflect increased interest of those who want to live in a single family house but decide to rent instead of buying. So this is really happening like across the nation, as you can see in this chart. It's pretty significant.
So everybody, okay. So fast forward to COVID-19. This is actually a really interesting thing that's happening. Is really the SFR space. It was already happening pre-COVID. Where look, they're building in the suburbs, Invitation Homes, and other private equity groups. And if anything, COVID, it basically accelerated the process where people could work from home. They could have their home office. They have more space. They have a backyard. They have, and this is really interesting. I kid you not. My father, for example, he lives in Colts Neck. He's renting his house out. This is a McMansion. He's renting it out for like almost $8,000 a month. It's like a 7,000 square foot house. Who thought you could rent that house out? Well, guess what? There's a market for it. And another interesting thing is that a lot of luxury houses with the SALT tax in New Jersey, it really came to like people stopped buying these houses. But now you see people migrating in droves from New York to the suburbs, and they're buying houses in like Saddle River or different towns, these $1 million houses. So if anything, COVID helped the luxury market in New Jersey. It's certainly helping, the luxury market in Florida, Palm Beach. That's a whole nother story. It's a safe haven as well. But Tay, I know you got some more notes on this as well.
Yeah, this one, this is pretty another interesting data. In this map, basically showing net movers by state across the country this year. So the red color indicating net outmovers in states where there are large metropolitan cities such as New York, LA, Miami. A lot of families or individuals in urban apartments, space, both indoor and outdoor. Interesting enough, the New Jersey and Connecticut are seems to be the beneficiary family find a house in New Jersey. Not surprisingly, I saw so many people from New York City actively looking to move into New Jersey, mostly single-family houses, but then even apartments. So a lot of people moving out of the city and looking for more suburban environments. Okay, moving.
I have friends too that they worked in the city, lived in the city, and they just bought a house in Maplewood. Good friend of ours, and there's other people. So it's happening,
Yeah, exactly.
And guess what? They work from home. It's unbelievable the trend that's happening. It's and my other company, Arca Capital, everybody works from home now, and people are actually more efficient working from home. It's unbelievable. I have one of my good friends is a trader, for a bank. He said he's more efficient working from home. So hopefully, maybe this trend is here to stay. This work from home.
All right. Yeah, this is pretty much the same notion as the previous page, but by city. So what we found somewhat intriguing here is that even within the same state, people were seeking to get suburban feels in their living environments. So case in point is the states of New York and Florida, right? If you look at them, both of them are rather. This is another telltale evidence that COVID-19 made people more keen on suburbs.
Anybody have questions? Put them in there. Okay. All right. So what's ahead of SFR? Here's the good stuff. Okay. So SFR is growing exponentially. Okay. So we are talking that single family houses is only owned by 0.2% of institutional investors, which means there's a lot more room to grow. Okay. In fact, Tay, you could share some of the data on that. Elaborate a little bit more on that.
Oh yeah, so this data basically showed the how little share is really owned by institution. So really about despite recent investment by high-profile investor, institutional exposure to SFR is very limited. Yeah, about like a 1 to 2% of a 9 million unit market. That's such a tiny share compared to the U.S. multifamily sector, like a 55% owned by institution today. Multifamily apartments have largely been institutionalized starting in the early 90s, and the landscape is very competitive. On the other hand, SFR is only now emerging as an institutional asset class. So the overall SFR sector is very fragmented at best, which provides immense opportunity when the sector can be more consolidated. So in our view, well-capitalized investors with vertically integrated operation will stand a better chance of having an edge and reaping the most benefit from this opportunity, like untapped territory.
Yeah, another thing. Yeah, exactly. And what's happening is, like I said, if you just Google single family rentals, the news, you're going to see more and more private equity firms. They're forming joint ventures or entering the market. You're seeing apartment developers going into build for rent single family homes. You're seeing, there's a lot of more, like, for example, we're investing with a new with an operator that wants to be the Blackstone workforce housing. So there's a plethora of entrants coming, but only probably about 10 or so can actually do it at a large scale. Okay. But if you're like, let's say if you're an active investor, what I would do is I would in Philadelphia, right? If you follow where we're investing, we're improving neighborhoods, and the goal is to create value. So if you're investing in the same areas we are, you're going to benefit as well. So if you're active, so this is definitely a time to really get into it. And anybody have questions? Okay. Now this is interesting. Okay. Now what's really interesting is we're talking about the mom and pop investors. So traditionally, like, single family's been around forever. It's really been around. But it's really traditionally owned by like someone that lives in a house or a mom and pop investor. They own less than 10 houses and they own it as rentals. So 45% of SFRs are only owned by investors who own just, let's say, one unit. Nearly 9 in 10 have portfolios of 10 or fewer single-family homes. And the share of investors in single-family rentals, it's really, it's growing. It's growing, and what's happening is growing because institutional investors, they're buying, and they're not just buying 10. We just closed on a fund recently to buy approximately 50 at 50 homes. Before that, we closed 15. Now we're opening up a 200 unit fund. So it's possible. Hey, I know you have a little bit more data you want to share on this.
This one is just we wanted to point out how fragmented this SFR market. So it is really important to make it scalable by realizing the what's it called? Like a consolidation. Yeah, kind of consolidation, like upside potential through like a consolidation of the market as a whole down the road. Yeah.
Yeah. So basically what's happening is the SFR is going to be owned by institutions, and that's what's happening. And it's already in that trend, already heading in that trend. And if anything, later on down the road with the mortgage forbiddance, eventually that's going to come up, and there we go again. The auctions are going to open again, and portfolio sales will happen again, or not. It's going to happen. Tay, you take this.
Yeah, that's right. So as we all know, there's a rampant issue with affordability in the United States. So in terms of new for sale housing, there has been more focus on the higher end of the market than smaller, lower price homes. Higher costs for labor, land, and materials really drive builders to secure bigger margin from more expensive home. Consequently, high demand and low supply of affordable SFR properties continue to push up rents. So more than 30% of income being spent on rent places the label of rent burden on households. In 2016, Harvard researcher found that almost half, like 50% of renters were rent burdened. So the map on the right side represent affordable and available rental homes per 100 low-income renter household by state. And it really shows housing affordability is a rampant issue nationwide. The U.S. will need 7.2 million more affordable homes to meet the current demand. So the bottom line is there's an enormous opportunity to serve rent burden households with new supply of affordable products throughout the states.
Exactly. We're very bullish on affordable workforce housing. That's what we're investing in currently ourselves. And if anything, it's almost impact investing. We want to help others as well, but that's a whole nother topic we'll go into. So this is an interesting topic. It's the growing demand for build to rent. And what's happening is that you have developers that they're building in the suburbs, and really what's happened is the financing is available. So in that sense, builders could obtain favorable financing, where they could buy land, they could build, and then they could keep it as a rental, or they could buy, build, stabilize it, and then there's actually institutional investors that will buy the whole community from them. Almost like, so for example, let's say you have a developer that builds an apartment building, right? Well, that developer that builds an apartment building, they're going to sell that to a pension fund, right? That's how developer makes their money. They buy, they build, they sell. Same thing. You have, let's say, what's the name of the company over here? You have, let's say, I'm drawing a blank on one of them. Toll Brothers. I know they're in the market. They're actually in this market as well. they're going to buy, they're going to build, and they're going to stick itself a whole portfolio to an institutional investor the same way as that investor buys an apartment building. And they manage it the same way because they could deal with economy, they could deal with the technology, improvement in the capital markets, and they're dealing with economies of scale. And Tay, I know you have some more that you could shed light on this as well that I left out.
Yeah, I mean, we are kind of getting overrun, running out of time. But yeah, just due to lack of affordability, the build to rent is becoming more accessible to those who want or need single family home, but cannot really afford to buy. So that's what really drive up the demand for a build to rent.
It's really for a lot of it's for millennials. That's what they're doing because they want a newer product. It's there. This is a very big trend, and we could touch this on a whole nother webinar, but this is like a high level view. Okay.
Yeah. And so we have another. Yeah.
Yeah. All right. So real quick, basically, like I said, 0.2% is owned by institutional investors. This is the geographic map, right? There's a lot more room for growth, a lot more room. Okay. And hey, I know you want to.
No, I mean, just wanting to point out the circles in different sizes really represent the footprint of top 15 SFR institutional investors. Yeah. So clearly their collective presence is really heavily concentrated on the Sunbelt region, the bottom portion. This means investor can continue to venture out to more location nationwide and achieve geographic diversity. Yeah. So a lot of opportunity for everyone. Yeah.
Exactly. For example, we're investing in Philadelphia. We're one of the early entrants there. But guess what? The plan for that sponsor is to go nationwide. They'll go to other areas like Detroit. They'll go to Baltimore. They'll go to Atlanta. There's so much there's so much there to invest in. Like we mentioned before, it's only the SFR is only owned by 0.2%. There's so much more to buy, and there's so much more room for growth. Okay, key takeaways, right? I know this is a lot of information, and thank you for staying with us. So really, this is what the key takeaways. The financial crisis disproved conventional wisdom that the scalability of SFRs was not feasible, largely thanks to improved capital markets, technological advancements, and the demographic shifts. Okay. The financial burdens coupled with the demographic trends and preferences fueled the growth of the SFRs. Single family housing, it really continues to be undersupplied, which means we really need more. There's more demand for rentals, okay, because we're turning into a rental nation. And another thing too, I like to say, if you're an active investor, like say a mom and pop investor, follow the smart money. Like I said, if someone's building in an area, let's say we're investing in certain parts of Philadelphia, I would follow where we're investing because if anything, we're setting the comps, we're market making those areas, we're improving it. And eventually 5-10 years down the road, there's going to be a lot of, a lot of appreciation, so that's.
Yeah, exactly. So I can also stress enough, the importance of, watching the institutional movement. So where they're buying and what they're buying. So watching them really can teach anyone a great deal about how to analyze, acquire, finance, and manage investment property. So small mom and pop investor may not be able to compete with large investor on the same individual asset, but they can still achieve success purchasing different products, like in terms of size or price in the same market, or be active in markets that the institutional investor do not participate in. So remember, as Adam keep emphasizing, the institutional investors own less than 2% of all SFR investment properties. and they are active in less than 30 or so metro areas across the nation. So that leaves a lot of room for everyone else. So we firmly believe SFR will continue to differentiate itself as a stable, long-term institutional-owned asset class, and the SFR sector is bound to provide a tremendous opportunity for investors, as multifamily did. So, as we all know now, there are not enough homes and not enough affordable housing. If you focus on creating supply in the market that have a need for quality affordable housing, yeah, you can seize the opportunity and ride up with this trend. Yeah.
Okay. So yeah, so basically the key takeaway is, you know, for myself, I missed out in '08. I was in college, undergrad. I was wrestling, studying business. I missed out. Now, um, I am in the trenches and I am looking to exploit this opportunity. We already invested in 2 funds, and I want to just keep on building up this is how wealth is made. Multifamily is a very attractive asset class. For me, I personally see a lot more growth in the residential, the single family, SFR, and small multifamily. And that's just there's a few factors. Number one, you could buy at a higher cash yield going in versus multifamily, and there's a lot more room for growth. But we'll save that for another time. Let's answer some questions. We're going to open up for a Q&A. So, Tim, historically, why have institutional investors avoided this segment? And you want us to highlight the downside? Well, really, the reason why they avoid it is because it was the scalability. It's how you going to manage homes, thousands of them. There was no technology. There was no transparency. There was no cloud computing. There's no way for them to really, like, how do you monitor things, right? That's available now. They have the technology where, I mean, I know there's software like Housing Canary. I know one of the sponsors we invest with, like, they have like heat maps. You can see the MLS. So you see where they're buying, values, estimates. You can see like so much information. Another thing is, it's in order to really run things efficiently, you really need to be vertically integrated. Like, most investors cannot achieve it at scale. For example, one of the sponsors we're investing with, they own the property management company. They manage over 3,000 rentals. They have a construction company. They already have a track record of, doing this they're already doing this. And one of the affiliate companies is one of the largest apartment managers in the nation. So they could leverage the affiliate company they'll leverage all their contacts, and that's how they're really going to achieve it. I mean, they could do things cheaper because, their materials, they're buying in bulk. Contractors, they have the contractors on payroll. Technology, I mean, they have a new software called Builder Trend to manage the renovations, and they use I think AppFolio for the property management, and I believe they have Housing Canary to help them with market analysis and figuring out values and estimated rents, and there's some other stuff that I'm missing out because I actually want to explore the software myself, and I'm still learning more about the different technologies that are out there. But it's improving. Downside risk. Look, so that's a really good point. So, for example, Daniel Edry, he's one of the managing partners of TC Exotica Homes. He started out. He has over 20 years experience in commercial real estate. Started out as a mezzanine bridge lender. He invested in a lot of luxury product. And pre-COVID, I remember speaking with him. Sorry, I got something. I remember speaking with him, and he said that he doesn't want to be in a luxury product. He wants to go to the bottom demographic, workforce housing, because it didn't take a rocket scientist to know that we're at the end of this cycle, and he knew that by being in something that's affordable with $1,200 a month rents, a market downturn, if anything, those rents will be stable. Obviously, there may be problems, but in the most part, yes, the service industry in this pandemic was hit hard, but the tenants that they have, like for example, they manage 3,000 units right now in Philadelphia. They're running at 90% occupancy. The reason why is because their tenant base are considered essential workers. They may work in the food industry, but they're working for a big box, a big chain restaurant that is still open, or they're nurses, or so their tenant base wasn't really affected by this pandemic. And if anything, for new tenants, they're going to screen them properly. That answer your question. I mean, the downside risk. Yeah, if you're investing in a luxury product, I think you could see downward pressure on rents because of usually when the market turns, you're going to see a downgrade from Class A to a lower quality product, a type of product. They're going to come to the workforce housing. That's just really what happens. Another factor is, I mean, look, you make your money on your purchase. I mean, I know you don't want to over leverage. Obviously, you want to keep healthy leverage. There's certain things, but okay, cool. I got answered your question. All right, great. I can keep on going on. As for what you guys are invested in, what is the vintage of SFR you guys are invested in? Hey, you want to take that one?
Oh, this is like a TCS Anika Homes SFR. So, what's the vintage? Oh, sorry, I have a trouble under a vintage. What is a vintage in this context?
We're invested in workforce housing, and I mean, typically what we're doing is we're buying. This is buy, renovate, refinance. We're doing like the Big Burr method. So, for instance, we right after the pandemic happened, we opened up a fund because we saw an opportunity to buy at a discount, and really, we're buying someone else's problem. So, what's really interesting is that right now we're dealing. So obviously, there's the eviction moratorium, and so that's causing a problem. So as an investor like us or you guys who are investing, the vintage of the age of the product. These are what's the age of the product again? It's 19. Hey, I'm drawing a blank on the age of the houses we're investing in Philly.
Yeah, that's really like old houses. Yeah, it's very
I'm drawing a blank. It's
I mean, some of them really require like a gut renovation. And...
No. Give me 1 second. Hey, answer a few more questions. I'm gonna get this answer right now. I'm just drawing a blank right now. I don't know why I'm drawing a blank on the age, but I'm gonna get this right now. Hey, you can answer.
So what's the average net yield you see in the SFR market? So I guess we can answer the question from our first-hand experience with the TCS Anika Homes. So we are really doing the value add strategy in an affordable rental market in Philadelphia. So our target IRR after doing all the underlying assumption is reasonable range is like about like a high teen per percentage, like 18 to 20, like a IRR. And then the equity multiple of like a 2x over like a 5-year hold. So I would say, like, obviously all the target return and the likelihood of realizing it is a vary across the states, but at least like Philadelphia and where we're investing in is affordable housing. That's really what you're likely to achieve in the market.
Yeah, so it just dawned on me, 1920s build typically. That's where we're investing. These are older homes. So yeah, that's the area that we're in different parts like West Philly, North Philly. Yeah, these are levered returns. Correct. But what's interesting is that our cost of financing, for example, we're taking on we have a line of credit from Corvest, and it's non-recourse debt, meaning there's no personal guarantee that the sponsor has to provide. Obviously, there's bad boy carve-outs. And the first fund we closed, it was 7% interest only for 18 months. Unbelievable. The money's cheap. They're getting that because they're considered like an A-class borrower. When we refinance into, let's say, we may take on 5-year type of money, we're going to be sub 5%. The money's cheap, and if anything, it's going to become cheaper. I mean, the market did shut down for a little bit in March, and it came back, and it's like a V-shaped recovery for the lending. It's coming back, especially in the space that we're in. Any more questions? Yeah, so Ben mentioned that the government is providing support. These are all good questions, and what we're going to be doing is, I mean, this is just Tay and I, but we're going to invite on the team from TCS, where maybe we'll have Joseph Puggi. He is head of property management. He could answer questions better than I can for what they do with property management. We could have on someone to talk about construction management with Mike Faris. I'll even have Daniel Wedry, maybe on Ben Aller. Raj, what was the non-recourse rate? So pre-COVID, when we closed this fund, and we closed it around March, I believe. Right before it shut down, it was 7%.
Yeah, right.
It was 7% interest only. Then we closed the next fund in when was it? June, I think we closed it.
Yeah, around summertime. Yeah,
that was 8.5%, and then now we're looking at again at 7%, because the 8.5% was right at the market just came back. Just the securitizations, the secondary market just shut down, and now it came back. So that's why it was a little bit more expensive. Not a slap in the face. The leverage did decrease a little bit. I mean, we were looking at on the purchase at 85%, and then it went to 25%. But now the leverage has increased because the credit boxes are opening up because of the confidence in the market. There's more money being pumped into the market, basically. That's driving the rates, and it's really opening up the credit boxes and driving. It's really compressing the interest rates. Sharif, how can you follow up with us? You could visit us at levinecapital.com. I could actually type it here. You can even email me at Adam@Levine Capital. Adam@LevineCapital.com. We have a YouTube channel too, because we try to do a video once a week where we like to share knowledge. I mean, look, this is something that we're very passionate about, and I really hope that we were able to. Oh, you want to start with LinkedIn? Oh, you want my LinkedIn profile? No problem. I'll get that. Tay, while I'm getting my LinkedIn profile, you want to answer some more questions? Who else has more questions? Because you have us here and ready to answer questions. And if I don't have the answer, the good thing about this business is, I'll tell you what, I don't know everything, I'm a student of this of real estate. I'm always studying, but I surround myself with people that have that. I mean, like I said, Daniel Edgy, over 20 years experience. He's been around through multiple cycles. If I have a question, I'll call him up. Maybe I'll call property management. I'll call Joseph Pucci. Construction, I'll call my partners at Arcad. So really, this business is a relationship business. And now that you're on here on this webinar, now you know us. So if you have questions, feel free to ask us. You know, that's really what it comes down to. Here, let me get you my LinkedIn profile. Someone else has a question?
Yeah, we have a question from Tim. So are you always looking to achieve 2x equity multiple?
Yes, that is our target equity multiple for a 5-year hold. We do, yeah, we looked for that. IRR, the internal rate of return, we look for like a 17% or more. And what's really interesting, Tim, is that with the single family rentals compared to multifamily, you know, we could repatriate our equity much, you know, sooner than multifamily. For example, fund 3 that we closed on, we're looking to repatriate in less than 2 years. I think it's it was like 18 months, or maybe soon. It may be sooner now. We underwrite very conservatively, but usually, you know, things should work out better than our underwriting assumptions. Yeah, deal level IRR. So the deal level IRR is more than the mid-teens. Obviously, the sponsor's going to take their promote as well, but us as a deliberative partner, we look for a 17% or more for us. What's really interesting too, Tim, is that you know, since we're investing, let's say a minimum of $5 million or more, we can negotiate more favorable terms with the sponsor because of the capital commitment. This could be for any sponsor you're investing with. Typically, when you're investing more, you could ask for more. If you're a private investor, you're probably you're not gonna get better terms than someone that could write a larger check. Michael Levison, he shared something from the New York Post. Thank you. I gotta look at that.
Wow, yeah, very exciting. Yeah.
Oh, technology changing. Oh yeah, thank you. I'm gonna read about that. Yeah, I mean, look, there's technologies happening. Like I said, housing canary is something that I know TCS is looking into. There's so much they have a single family rental housing index. That's CoreLogic has that. Unbelievable. Yeah. Anybody else? Am I answering everybody's questions? I hope I'm not missing anybody. Who else do we have? Oh, here's Bill. The 10-year plan should be to purchase these single-family homes of people entering the financial hardships, forced to sell their home. They will not rent a different SF home. They will seek specialty built multifamily housing. So there is one shift that's happening that I'm seeing. I saw an article in the Wall Street Journal that there's private equity shops that are it's really it's a sale leaseback, for example. I'm not answering this question, but I just want to throw this out there, is that sale leasebacks are typically for commercial transactions. But what's interesting is that you may have someone that has equity in their house and they need liquidity. Maybe they don't have a lot of money in the bank. So a private equity firm will buy the house from them and they'll lease it back to them, keep them as a rental. So they're saying, hey, you don't have to move out. You could live here still, but we'll rent it out to you. And there's some other thing. There's other investors out there that are saying, hey, this is something else that I discovered. It's like, hey, you want to tap the equity in your house, so we'll be an investor in your house, and then we'll share the appreciation on the house. So whenever you decide to sell it, we're gonna share the profits when you decide to sell it. That's a little off topic, but the point is, there's a lot of money that's entering this market, and there's a whole securitizations market for this. And I mean, there's technology out there where you can actually buy fractional shares of a house. So look at our roof stock. If you want to buy a house, you can actually own like a fraction of one house. It's unbelievable what's happening in this market. It's only going to improve. Anybody else have questions? Anything else? Yeah. So look, we're going to have a webinar once a month, and, please do me a favor. This is our first webinar, and the whole idea is for us to really keep on doing these. And if there's anything that you want us to discuss, share it in the chat, shoot us an email. You can find me on LinkedIn and let us know what else you want us to talk about, and we'll be more than happy to share that in the next webinar. And maybe we'll invite one of our guests on, maybe Daniel Edry, maybe Ben Aller, maybe Geographic. These are all the managing partners with TCS. And let me tell you something, it's such an incredible relationship because, as a student with a master's in real estate management, as working for, in this with my father, I'm learning so much from them. It's unbelievable. And they're just incredible people. It's such a great relationship that we have. Are we hiring? No, we're not hiring. But shoot me over your resume, Tim. Maybe I know people that are hiring. You never know. Maybe I know my company Arcade Capital is hiring. We're hiring sales, a loan originator. How do small investors can access more capital? Can you elaborate more on your question on that? Because a few things, right? Now, it really depends upon the way you're investing. So let's say you want to be a passive investor. So to invest with, let's say, in private equity, depending upon how they register, most of the time, typically you have to be an accredited investor, meaning that you need to have $200,000 a year in income, or a combined total, if you're married, $300,000 or $1 million in assets, not including your personal residence. If it's a Reg A offering, which is like a mini IPO, then you don't have to be accredited. And I mean, I see crowdfunders where they'll take I think I've seen somewhere take like $500 or something, or $5,000. So there are ways for smaller investors to invest. Did that answer your question? Or let's say you're a small investor. I mean, just go to a market. Like if you want to be an active investor, just go to a market where, Philadelphia. I mean, they have properties you could buy for like $100-something thousand. You just go to areas where it's cheaper, and you could certainly invest with less money out of pocket. Or another way is just partner up with other people. Like for example, the second and third fund we launched, the minimum investment to invest with the sponsor at that time was $200,000. They just raised it to $5 million because now they're only dealing with institutional investors. But at that time, my minimum investment to invest with me was $25,000, or our minimum investment. Before Tay became a partner, it was $25,000, and then Tay partnered on, and then it was still $25,000, but now Tay's a partner. But I just raised that minimum though. But yeah, if you want to invest, you just have to look at the minimums. I mean, some minimums could be 10, some could be 5 or less. So yeah, that's a way to get in if you're a smaller investor.
And also, like these days, there are abundant crowdfunding platforms out there, so which kind of lower the entry level, lower the minimum investment. So you may want to kind of explore what they have to offer. They lay out really the list of all the sponsors they work with. So yeah, if you are not accredited, I mean, you can look for their opportunities.
Yeah, another thing too is I like to just mention, for me, like there's a lot of opportunity out there. This is a whole other segment. There's a lot of crowdfunding opportunities. Just just know what you're getting into. It's kind of it's a new industry. That's something that I'm very careful of. Raj, small investors with excellent credit can, so that's one. So one thing is, so let's say you're looking to obtain a loan. So my company, Arca Capital, we provide loans for investor loans, business purpose loans to Raj. Are you looking just to buy a house to rent out, or are you looking to fix it up? Let's keep it simple. Let's say you want to rent the house. Let's say you have a 700 credit score. Look, you're purchasing it. We could leverage you up on a purchase. All you have to come out of pocket is 20% down. Let's say it's a $100,000 house. Put $20,000 down. You know, and buy a house rent. Yeah. So if it's buy a house, this is a non-QM rental product. It's not bank money. We're not looking at your bank statements, not looking at your tax returns. All we care about is your credit, and that's it. And then so right now the max leverage on a purchase is 80% on a purchase. Keep in mind though that these are debt service. These are DCR loans, meaning that they're very sensitive to cash flow. So typically, you may need to run it like around a 1.25. High level, you need to make sure the cash flows appropriately so you can leverage out the most on a purchase at 80%. You want to put less money down, just go to a lower price market. Is the fee a 2 and 20 structure like a hedge fund, Tim? No, we are. That's actually interesting. We didn't have that structure on the first two funds we did. We are going to negotiate with the sponsor a preferred return and maybe an 80-20, but that's right now we're still in we're still building out the model. And then we're going to negotiate more favorable terms since we're investing as an institutional investor. Meaning if you invest with us, Levine Capital, we're going to aggregate, let's say $5 million minimum. Then we're going to negotiate what our preferred return is and our split, But probably, it may be an 80-20 type of split that we'll look for. But look, it's all a negotiation. But I hope that answers your question. But fees, they're different. I mean, everybody has their own fees. But if you want to get an 80-20 split, typically you have to be a larger investor to get that. Or you invest with if you're investing with an inexperienced sponsor, you could probably get more. The experienced sponsors, like the ones we're investing with, you're not going to get as much investing $100,000. In fact, they're not even accepting $100,000 investors anymore, because now they just want to focus, like I said, on more institutional. But we could always talk about that more later. So Tim, Raj brought up a good point. I'm looking at a fix and flip. We're looking to get out. All right. You know what? So let me do this for you guys. Let me give you my company, Arca Capital. Now, keep in mind, we just lowered our rates for the rental loan, and we loosened up the credit boxes. That it hasn't been updated yet on the website, but give me your email and I'll send you over our updated programs. But here's our website to check us out. Did it go in? Arca Capital. So rates on a fix and flip, I mean, we're at 8.99%. For experienced buyers, if you have 3 deals or more, you're at 8.99%. We can leverage you up to 90% of the purchase. We'll give you 100% construction up to 75% of the future value. But hey, Tim, we could discuss this on another call, because that's definitely another topic. And I would love to discuss that with you. And definitely, if you're experienced, typically experienced, you're going to get the best terms. but we could lend to someone with no experience. The only difference is with no experience on a fix and flip, you're going to have to put down 20%, and you're going to pay around 10% on the money. Okay. Anybody else have questions? Oh, I love these quite. Hey,
I love this interaction. Yeah. The webinar is overrun, but people are staying, and I really appreciate all the people staying with us. Yeah,
I thank you. I really appreciate it. I know everybody's busy. I know everybody has families. I know it's 9:00 East where we are, Eastern Standard Time. I know for you, Tay, it's was it 11?
Yeah, 11:03. Yeah, a.m. Yeah,
a.m. So Tay's in Korea. So.
We literally work around the clock these days.
We do.
Yeah.
Oh, you want my email, Arcade Capital? Sure, Nancy. Absolutely. It's
Oh, thank you, Tim, for urging us on. Yeah, we actually really enjoy this experience, connecting with more people out there. And our the video is really titled "Learn, Invest, Grow." So that's really our principle. We like to learn ourselves, and then we like to also share with others so that other people can continue to learn, and we invest together, not necessarily through our partnership, but I mean, as a investor community, right? We invest together and then also grow, for the future. So that's the whole idea of what you're doing.
Yeah, I mean, look, real estate, it could take a lifetime to master an asset class. So really, for us, we like to share our knowledge, but I mean, it gives us an opportunity to study because I'm always studying, and I love to go back to the textbooks to refresh my memory and then share that with our audience. And really we like helping people too because there's so much to learn. And another thing too is that I see that there's a lot of marketing going on, and people, like I said, are touting multifamily this, and that's why we're like, okay, well, let's talk about the single family because, single family, there's so much. It's easy to get into if you're someone looking to start out, and it's scalable. And if anything, there's a lot more room for growth, and that's why we want to really share this with others. And we're looking to scale up ourselves. Like I said, now we closed on 15 portfolio. Now we're closing on. Well, it's a fund, so we're almost filled up the fund. I think we're gonna have 50-something properties, and then we're gonna launch another one. And this is our wealth builder, for the future. And this is a way my father, for example, another thing too, actually, let me share this. Watch my father's interview. My father, a retired dentist, he was able to build his wealth in real estate, able to retire over 20 years ago. Actually, more now. It's almost 30 years ago. And he built his wealth starting out with single family homes. So let me send you this video as well. And I think that's it. I think anybody else have questions? That's my YouTube channel, by the way. You could, the video from my father, watch it. It's a good interview. That was conducted about a few weeks ago. Love my father. Just humbly, just happy I was able to do that. We're down in Palm Beach. Anybody else have questions for us? All right, Michael, thank you so much. All right, so I think we're gonna wrap this up. I know everybody. Let's keep in contact. COVID, we're on the Zoom land or webinar jam land, and eventually we could always have an in-person meetup, and we're going to have this once a month. So please, let your friends know, share this, and leave us tell us also how we can improve things, because we're always looking for room for improvement, and we know that we're going to get better as we go. And we're going to constantly be studying. So the next webinar will have even more information for you guys. And if you have any questions, feel free to reach out to us. And again, thank you so much for taking your time out of your evening to join us here. This is really just an incredible experience for us, for Tay and I. Thank you.
Yeah, absolutely. Yeah. Thank you very much, everyone. Yeah.
Okay, so we're gonna get going now. Everybody stay safe. And we look forward to seeing you on the next webinar. And connect with me on LinkedIn. I'm on Facebook. Please like, share our YouTube channel that we're creating content. And thanks again for joining, everybody. All right. Okay, we're gonna sign off now. Take care, guys.
Yeah. Have a good night. Yeah.
Good night.
See you later.